I would like to welcome you to our class this evening, where we are looking at the concept of financial performance. Of course, unfortunately, we had a bit of a gap. So I realize that the flow has somehow been disturbed, but we shall correct it. What have we managed to do so far? Well, we defined what the course is all about, what performance management is all about, that we have done. We want to build on that foundation. We want to build on that foundation in terms of the concept of performance. So we want to build on that concept of performance. So that's what we want to do now. We spoke at length on the concept of objectives. So we discussed the concept of objectives. If you remember very well, we spoke about objectives. And we say that in performance management, our focus is to help organizations achieve these objectives. So that's what we are really focusing on. Can we help our organizations to achieve their objectives? We want to help our organizations improve performance. So that's the focus on this course. This course is about helping organizations achieve their objectives, helping organizations improve their performance. Now, let's talk about objectives. What is the key objective that we want to help organizations achieve? What is the key objective? I also normally say, when we talk about good performance, when we say that a company is performing well, what performance are we talking about? I also even say at individual level, at a personal level. At personal level, if you say that your friend is performing well, what do you mean when you say your friend is performing well? He's doing very well. Even at family level, when you say, our family friend is doing very well, what are we talking about? I'm sure you agree with me that what we are talking about is primarily financial performance. So primarily we are talking about the financial performance. And that's the same with the APM, or performance management. When you're saying that the company is performing well, we're talking about primarily the financial performance of the company. Primarily, we are talking about the financial performance of the company. Therefore, the way we are going to proceed on our course is that we want to focus on the financial performance. Then we go to non-financial performance. Then we bring everything together. And that is what we are starting to do tonight. So what is the case for financial performance? How do we justify the fact that when we talk about performance management, primarily we are talking about the financial performance? Well, the justification is in the statement that we have here. The main objective of commercial organizations is to maximize the wealth of the shareholders. And the wealth of the shareholders or the owners are looking at the financials. So the owners are looking at the financials. And primarily, that's what we are focusing on. Primarily, that's what we're focusing on. And today, in this session, the sessions to come, we will be focusing on the extent to which we have achieved our shareholder objective. Primary shareholder objective. So let's break down our topic then. How are we going to proceed? What are the components? So we have picked items that are related. What we have done is we have looked at items that are related on our syllabus. And we have decided to bring these items together. These items are what we call general financial performance, benchmarking, and predicting corporate failure. These items may come from different areas of the syllabus, but this is an efficient way of handling them, where at one time we bring all of them together and we deal with these items. Back to the syllabus. Like we said last time, we want to stick to the syllabus. In preparing for an exam, we want to make sure that we really stick to a syllabus to make sure that we have covered items on the syllabus. So we've come back to our syllabus. I want to demonstrate where are we. Well, in terms of the syllabus placement, we're in area D. Area D is called strategic performance measurement. That's the area that we are in. Strategic performance measurement. So in strategic performance measurement, we are looking at really financial performance. Now, look at the requirement, learning outcome. The learning outcome is that we must be able to apply. Apply what? Appropriate strategic performance measurement techniques in evaluating and improving organization performance. In evaluating and also in improving organization performance. Now, this verb is high level. This verb is high level. It doesn't just say calculating, no. We want you to apply an appropriate performance measure. So earlier on in F5, we'll ask you to calculate ROS. We want you to calculate ROS and to comment. But here it's not calculating anymore. We want you to find an appropriate performance indicator. Or if we ask you to calculate, one of the major items we want to talk about is how appropriate is performance measure. So some of the items to be covered is the strategic performance measures. Now this expression, strategic performance measures, these really are what we call KPIs. These are also what we call ratios. In this area of the syllabus, we're also going to look at the concept of the division. Division performance and transfer pricing. We're also going to cross over to look at the case for not-profit organizations. We're also going to look at non-financial performance indicators. We're going to look at the concept of quality. We're going to look at the concept of HR and also some behavioral issues. Let's go to breakdown. Let's go to further breakdown of the syllabus. Let's go to further breakdown of the syllabus. In detail, our syllabus says, number one, demonstrate why the primary financial objective should be concerned with the benefits shareholders. So the primary financial objective, which was supposed to help our organizations achieve, is the concern for shareholders, or what we call also maximization of shareholders' wealth. Maximization of shareholders' wealth. Maximization of shareholders' wealth. So this is our primary financial objective, which we want to help organizations achieve. So then, what are the KPIs? Discuss the appropriateness. So like we have said, the issue is appropriateness. Discuss the appropriateness of and apply different measures of performance, including the following. So you are supposed to tell us about how appropriate these are. That's a major part. So what are some of these ratios? Gross profit and operating profit. And you're going to notice that on this course, operating profit is a very, very common performance indicator. Then there's your return on capital employed, your ROI, your EPS, EBITDA, residual income, net present value, internal rate of return, including the modified internal rate of return. Then there's the economic value added. Now, some of you may want to ask a question, is that, so are these the only ratios? Are these the only ratios? Let's look at the statement here again. It says, discuss the appropriateness of and applying different measures of performance, including. What does that statement mean? When it says including. When we are saying including, what does that statement mean? It's not, these are not the only ones. So to whatever list you have, let's also make sure that these are covered. So these are not the only ones, no. These are not the only ones. We must also include these to the list. Whatever you do, make sure that you have covered this. Now, if you notice here, mainly we're talking about the profitability. If you come here, discuss why indicators of liquidity and gearing need to be considered in conjunction with profitability. This gives us a quick summary of the areas of ratios that we must consider. So what are the areas? Liquidity, gearing of financial risk, and also profitability. Compare and contrast short and long-term run financial performance, and also the issue of benchmarks. So it's very important that we do a clear breakdown like this on what it is that is expected from us. Then from there, we're going to go to the other area of non-financial performance, that will also be covered. So now let's talk about our exam. Let's talk about our exam. In our exam, how does the examiner examine us on financial performance? Traditionally, for many years, I always share with students that financial performance was about ratio analysis. Financial performance was about ratio analysis. Where students will be asked to calculate ratios and comment on them. So financial performance was synonymous with the calculating, estimating ratios, and then writing a report about how the company has performed. What of the current exam dispensation? Do we still have this question? Yes, this question is still there, but it's not as common. It's not as common. The question which has become more common now is evaluating the performance report. Is evaluating the performance report. So more likely, yes, you can get a question on ratios. But what we are more likely to get is where you have to evaluate a performance report. So two types of questions. We can get a question on ratios, but probably more likely evaluating a performance report. So which one are we focusing on tonight? Tonight, we are not focusing on evaluating performance report. Tonight, we want to focus on the ratios. We want to give a breakdown of the ratios. So now we're going to our ratios. So in terms of ratios, the first area, as you notice there when you're doing the breakdown, is profitability. So a company doing well, financially starts with the profitability. So in evaluating the operations of the company, we want to answer the question, are we profitable? Are we profitable? Have we generated enough profits? In other words, how do we compare our sales with costs? So what are our KPIs? What are our strategic performance measures? The primary one is return on capital employed. This is number one. This is number one. Return on capital employed. So ROS, how do you calculate your ROS? ROS is your profit before interest and tax over your capital employed by 100. So that is primarily your measure of profitability via the ROS. Profit before interest and tax. And the other time for profit before interest and tax is operating profit. And in capital employed, what do you put in capital employed? In capital employed, the capital that you employ in business is your debt and equity. ROS is further broken down. ROS is further broken down into profit margin and asset turnover. Profit margin and asset turnover. In this expression, ROS equals profit margin you take your profit margin and you multiply by asset turnover. Profit margin is your profit over multiplied by, you go over your capital employed. So that is your profit margin. That is your asset turnover. And as you can see, if you multiply this, what happens? That and that cancels and takes you to that. So the ROS is analyzed by breaking it into the profit margin and asset turnover. And these are our primary ratios. So ROS broken down into profit margin and asset turnover. The other profitability ratio is EBITDA, earnings before interest, tax, depreciation, and amortization. So by the time you cover this, then you're basically done with the answer to profitability. Are we a profitable operation? Okay, let's make a move. We have noticed that liquidity is equally very important. We have noticed that liquidity is very important. Profitability should also be considered in the context of liquidity. So you've got your current ratio, your quick ratio, receivable days, inventory days, payable days, and working capital cycle. And you remember from your basic studies that your current ratio is your current assets to current liabilities. And quick ratio is your current asset less your inventory. Over your current liabilities. And your receivable days, those receivable days, average receivables. Over your credit sales. over credit sales by 365. Inventory days, your average inventory over the cost of sales by 365. Payable days, the average payables over the credit purchases or if you don't have this, the cost of sales by 365. And working capital cycle, how long does it take when money goes in to come back into your business? So you add your receivable days plus your inventory days less your payable days. Yeah, so if you take your receivable days, you add your inventory days, you subtract your payable days, then you go to working capital cycle. So these are the ratios on the subject of liquidity. Now the question is, what have we seen on the exam? Do all these come? Not necessarily. Not necessarily. Once we have a we have had a computation, very basic computation, which would not cause anyone problems. What was that? I think it was inventory days. It was inventory days. Inventory days. Average inventory over the cost of sales multiplied by 365. So it's not really common that we get these questions, but in the process, we may have to do a basic computation. I hope that is clear to all of us. Financial risk is very important. Why? You see, as we are trying to maximize the wealth of the shareholders, as we are trying to maximize the wealth of the shareholders, we must not take undue risk. We need to monitor risk. We need to monitor risk, or we need to assess the level of risk that we are carrying. So how do you monitor the level of risk? Well, we use a gearing ratio. Questions would normally guide you on what ratio to use, but the ratio is debt to equity. That's a common ratio that you can use. Debt to equity. Or alternatively, some examiners want you to do debt to debt plus equity. Debt over debt plus equity. So gearing ratio, either in this format or in this format, can be used to monitor our levels of financial risk. The other one is interest cover. Interest cover, which is profit before interest and tax over interest. Are we able to cover our interest adequately? Do we have enough profits to cover our interest? Questions on financial risk normally also want to talk about business risk. They want you to assess business risk. So financial risk is linked to your capital structure. Financial risk is linked to your capital structure. And basically it's the debt finance that brings about financial risk. What of business risk? What brings about business risk? So financial risk is caused by capital structure. What of business risk? What causes business risk? Business risk is measured by operational gearing. And this risk is linked to your cost structure. This risk is linked to the cost structure. Which cost are we talking about? The cost is a fixed cost. So the business risk is related to the level of fixed cost that you have in the business. Why fixed costs? Well, it's because when business activity drops, the fixed costs do not drop. The fixed costs do not drop. So when there's a fluctuation in activity, what happens? You're likely to remain exposed on the fixed costs. So operational gearing is a measure of business risk. It's a measure of business risk. So what ratio do we use to measure operational gearing? We say contribution over profit before interest and tax. Contribution over profit before interest and tax. The higher the value or the quantity, the higher the level of financial risk. The higher the level of this number here, if the contribution is too big compared to profit before interest and tax, it's because there's a very big value in the fixed cost. So, in a consideration of profitability, we need to look at financial risk and business risk. Financial risk measured by gearing ratio and interest covers. And the business risk measured using operational gearing. And operational gearing is it contribution over profit before interest and tax. Ultimately, the primary objective is the investor, the shareholders. So we need to assess how are we faring in the eyes of our investors. How are we faring in the eyes of the investors? By calculating investor ratios. What are these investor ratios? Economic value added, total shareholder return, return on equity, earnings per share, dividend payout, dividend cover. Which one is a critical ratio? The critical ratio that you have here is economic value added. So when we come to assess shareholders' wealth maximization, when we're assessing shareholders' wealth maximization, shareholders' wealth maximization, the primary ratio that we use or performance indicator is economic value added, which we're going to discuss under divisional performance assessment. What of total shareholder return? Total shareholder return is made up of two items. What is all that? That's a dividend plus the capital gain. So dividend plus the capital gain. That gives the shareholder return. What of return on equity? What of return on equity? Return on equity is profit after tax over the shareholders' funds. Profit after tax over the shareholders' funds. The shareholders' funds include the share capital, plus the reserves. This is your shareholders' fund. So when we are evaluating how we are fared in the eyes of our shareholders, economic value added, total shareholder return, return on equity. Those are critical ratios. Investments, when you're evaluating investments, should we go ahead with an investment or not? Well, the ratios that we use or performance indicators are, we use the net present value, the internal rate of return, and also the modified internal rate of return. So these are the three that we are going to use. These are the three that we are going to use. So we're going to do some basic computation, just to remind you of this. I believe that one of the recent exams, some people say that there was a question modified internal rate of return. So we are going to practice that. Okay. After we have calculated the ratios, what do? We need to do some benchmarking. We need to do some benchmarking. We need to benchmark our ratios so that we make sense out of them. So we've got a topic here called benchmarking. So what is benchmarking? This expression benchmarking. So benchmarking is a performance management tool. This is a performance management tool on our course. And the examiners want you to explain or to evaluate this tool. So this is a performance management tool. So benchmarking is establishment through data collection of targets and comparators, which will allow relative levels of performance to be identified. By adopting identified best practice, it is hoped that performance will improve. So in benchmarking, we need the target. We come up with a target or the comparator. So we need the target or the comparator against which to compare our operations. So that we can compare performance. So when you benchmark your operation, what do you want to do? Well, we want to identify areas of underperformance. You want to identify areas of underperformance so that we can improve performance. You can now identify the gap. So who do you benchmark yourself with? You want to benchmark yourself against the best, or what we call the best practice. You want to improve yourself against the best. So the benchmarking exercise, for instance, after you've calculated your ratios, you want to compare yourself with the best. In our exams, I want us to mention the types of benchmarking that we have. So we've got internal benchmarking, competitor benchmarking, non-competitor benchmarking, and functional benchmarking. So one of the learning outcomes here is that we must be able to explain to us what is involved in these types of benchmarking. Internal benchmarking is comparing one unit or function with another in the same industry or same company. Internal with the same company. For instance, we may have two branches of the bank being compared. Sales outlets. we can compare two sales outlets. So if you're running a sales outlet, you can benchmark yourself against the best. So if we've got 10 sales outlets and there's one which is doing very well on a particular product, you can undertake an internal benchmarking where you compare yourself against another outlet from within. Of course, we can say that the problem there is that your improvement will be limited because you're comparing yourself with somebody within your own group. Competitor, this is where you are brave. You want to compare your performance directly to the competitors. The only problem is, are they going to give you the information and the KPIs and the ratios that you need? Will competitors be willing to share commercially sensitive information? What you may get is very much outlined, very general. But all things being equal, you can argue that the most useful form of benchmarking will be a competitor benchmarking, where you compare your performance with that of the main competitor so that you can see where to improve. Non-competitor benchmarking is more useful in the public sector, not-for-profit organizations. Compare against organizations in the same sector, although they are not competitors. Two schools, two public schools, two hospitals, functional benchmarking, comparing an internal function. You take one of the internal functions with the best external practitioner, regardless of the industry. So you take your call center and compare it with a call center of another company, which is not necessarily in the same industry as you. So you can take one of your many functions, internal functions, and look at who's performing that function well and compare yourself. So what are the advantages of the process of benchmarking? Remember, for calculated ratios, we have to do a benchmarking exercise. Assess current position, provides basis for establishing standards of performance. So at least benchmarking gives us a standard against which to compare ourselves. It helps to set objectives and targets that are challenging, but which have been achieved by somebody already. We can identify different ways of doing things. We can see what others do too. Disadvantages, we are saying that there's one best way of doing things in terms of the number one. Whatever number one the leading company is doing, we're saying that is the best. You're more likely just to catch up. Through benchmarking, you catch up. That's what you're likely to achieve. Now, there's an expression here that as students of APM, you must be familiar with. What is that? What gets measured gets done. So, what is likely to happen is that managers are going to focus. Managers are going to focus on those areas that are being benchmarked. Those areas that are being benchmarked. Those areas being benchmarked. Those are the ones that will be focused on. So other areas may suffer, isn't it? What gets measured gets done. What is not being measured? Impact on motivation for staff whose functions appear performing poorly. Yes, imagine take internal benchmarking. There's one outlet every time we are mentioning they're the ones doing well, and you want everybody to follow that particular outlet. What of the impact on the others? Won't they be demotivated? So as we practice questions, we come across questions where we deal with benchmarking. The benchmarks that you must use in your ratio analysis should be appropriate. What factors do you look for? Factors to consider to ensure appropriate comparisons are being made after you've calculated your ratios. Look at the industry. Are we in the same industry? Are we comparing like with like? Are we using the same strategies? The data that you're using for benchmarking, is it out of date or is it updated data? Use EVA rather than profit-based measures to benchmark the wealth of the shareholders. Remember that. And use profit-based measures or metrics when you're looking at operational efficiency. If you're looking at shareholders, use EVA. If you're looking at operational efficiency, you can use the profit-based measures. Okay, so this was our first bit to our discussion where we have just reviewed ratios. So today we've just reviewed ratios. In our next class, we'll come back. In our next class, we'll come back. We want to look at, having looked at that, we want to look at evaluating performance reports. In addition to that, we also want to look at the concept of corporate failure. So in our next class, we want to look at the concept of corporate failure, which may be highlighted by the ratios. In addition to that, we also want to look at how do we evaluate performance reports. So these are the items that you shall be focusing on in our class on Wednesday. Okay. So now we need to run. We need to run now. I think the year has started. We need to get ready for the exam, so we need to run. So let us become more serious now and let's start running and running fast. All right, people, so we're going to see you on Wednesday. Remember, our class is 2013. That's the time for our class. Thank you very much for logging on.
Thank you.